Hello everyone, my name is Morgan Moore and I'm the Senior Research Manager in the Research Department of Campbell Soup Company. Today I'm here to talk to you about the exciting prospect of Campbell Soup Company's acquisition of Snyders, Inc. So the format of our presentation today will start out, just give a little information about who Campbell Soup Company is for those of you who don't know. Then we'll do a qualitative analysis focusing on the industry, Campbell's financial performance, and the factors affecting Campbell's performance. Then we'll delve into the quantitative analysis, so more of the financial side, the key ratios, company valuations, and the strategies. And then finally we'll end with our recommendation to the board on either moving forward or not moving forward with this acquisition. So first about Campbell's Soup Company. Campbell's, for those of y'all who are unfamiliar, is an international food processing company, and we make soups, non-alcoholic beverages, snacks, packaged fresh foods, simple meals, and we started back in 1869. We were incorporated in the New York Stock Exchange in 1922 under the name CPB. We've always been headquartered in Camden, New Jersey, and last year we reported tremendous sales of greater than $8 billion. So going into the qualitative analysis, first we're going to hit on the food processing industry, which of course is our competition market. The food processing industry is massive. It's projected to generate more than $3.03 trillion of revenue by 2020. And how we're doing that is taking agricultural products and basic food ingredients and transforming them into new forms of food that are packaged, distributed, and consumed by consumers. So currently there's 21,000 companies competing in the food processing industry today. Here are the largest sectors of the food processing industry. Processed meat is by far the largest, followed by dairy products, then edible oils, processed fruit and veg, baked goods, snack foods, and then pet foods. Of these, Campbell's actually only competes within 17%. So this is our portion of the food processing market where we're aiming to draw our profits. So now to get a little more specific about our subsegment. While we are in the food processing industry, we are specifically in the packaged food market. The packaged food market segment includes loads of packaged foods that y'all consume on a daily basis. Everything from cheese to condiments to noodles to potato chips, breakfast cereal, baby food, and maybe surprisingly, non-alcoholic beverages. So the good news. The packaged food market is projected to grow at a rate of 4.5% through 2020. North America, where we're located, has been the largest market for packaged food products for 2 decades. However, developing countries are starting to have more purchasing power and an increased population. So China, the Asia Pacific region, and India are becoming the new consumption leaders. So let's look at, with all this growth, where is Campbell's profit? So here you see our actuals, starting in 2014 with sales of $8.3 billion. We have actually decreased in sales by 4.6%. So now in FY 2017, we've reported $7.9 billion. Now our financial department forecasted these sales up to 2019, and unfortunately we're expected to see a drop of 3% additionally. So total, that means sales in the last 5 years will have decreased by 7.6%, or a really striking $630 million. So of course, with this revenue loss, we've been wrapping our heads around it, trying to understand it, and we have uncovered 3 main drivers. The central, foremost, and most critical driver to us is that soup sales have reduced by 9% just in 2017 alone. Here in this pie chart, you see that soups compose 34% of our portfolio. So this is huge. This is crippling right now. And the reason that soup sales are declining is that consumers are seeking fresh, healthy, and portable products. So soup is canned and it's not exactly portable. So another factor, these health fresh products, is the growing trend of consumers believing that eating healthy is extremely important. Here you see that baby boomers, 82% of them, and millennials, 72% of them, believe that healthy eating is critical. This is partly due to the fact mass media has publicized processed foods as having harmful chemical ingredients, unhealthy amounts of things like sodium and sugar, and then of course just that the canning process is inherently nutrient reducing. So none of these things are helping our soup sales. So another driver, snacks. 94% of American adults snack every single day. Currently, our portfolio has 32% snacks, which is good, but it could be stronger. And what we're finding is that specifically fresh snacks are growing the fastest at 6% in 2017 alone. So in the past few years, developed societies have shifted away from eating breakfast, lunch, and dinner, and now we're eating smaller meals and snacking in between. And that's what's really driving this big paradigm shift towards portable, healthy eating. So the final thing affecting Campbell's growth is the consolidation of the food processing industry through acquisitions, mergers, and mega mergers. Of course, we have all heard about Heinz and Kraft merging into one mega corporation and achieving fantastic economies of scale, including diversified revenue streams, increased brand recognition, superior shelf presence, retention of top talent, and of course, improved overhead ratios. And when large companies are achieving economies of scale, they can reduce their prices and it makes it harder for us to compete. We did delve into the market of consolidation in 2017 with our acquisition of Pacific Foods, which makes soup, broth, and simple meals. This purchase did enhance Campbell's core portfolio focus on soups. But unfortunately, as we have discovered, soups are an unprofitable segment right now. So maybe we need to consider something else. So just a brief overview, we've lost revenue. There's no hiding it. However, we know why, and that's a great start. Declining soup sales, driven by health trends, growing snack markets, and consolidation. Those are our three things we need to tackle. So here's our recommendation based on this new knowledge. Campbell's Soup Company needs to acquire an established snack food company with a robust portfolio and healthy products. That is going to fix a lot of our imbalances in our portfolio family right now, and we're about to talk about how and why. So we have, excitingly, selected a target, Snyders Lance Inc. Snyders Lance is the second largest salty snack maker in the U.S. They make cookies, crackers, nuts, potato chips, popcorn, and pretzels. They're actually even older than Campbell's, being started in 1912 under Lance Inc. They're headquartered in Charlotte, North Carolina, and they have impressive sales of greater than $2.2 billion a year. So we did some analysis on what would happen if we added Snyders Lance to our family of brands, and here's what we found. On the left-hand side, you see that snacks compose 32% of our portfolio. On the right-hand side, the post-acquisition portfolio would have 47% snacks. So a massive, exciting increase of 15%. And this, of course, is the profitable industry right now. So snacks is where the money is. So the double whammy of Snyders Lance is that not only do they provide snacks for our growth, they provide healthy snacks, which is even more growth. Snyders Lance focuses on better-for-you snack options, which include, to name a few, Pop Secret popcorn, Snyders of Hanover pretzels, Eat Smart Veggie Crisps, my personal favorite, and Emerald Nuts. Their brands are often gluten-free, organic, free trade certified, peanut allergy friendly, And most importantly, and perhaps excitingly, doctor recommended for diabetics and heart disease patients, which will obviously appeal to our health-conscious consumers. Snyder's is super committed to healthy snacking innovation. They founded Clearview Foods Division in 2015, and this group within their company specifically focuses on developing innovative, better-for-you snack products. So that will guarantee our future growth and innovation within the healthy snacking industry. So Snyder's also helps us achieve that economy of scale. It has one of the largest distribution networks actually in the entire business in the United States. It owns SL Distribution Company, which is product distribution and display fabrication. And this will benefit Campbell's by providing cost-effective downstream distribution and really excitingly product placement in new locations. It will also provide us other size-related benefits that are common to any large company, and that's increased negotiating power with suppliers, greater shelf presence with diverse retailers, increased brand recognition, and the enhanced ability to attract top talent, which has become a real struggle in this growing competitive industry. So now that we've talked about the qualitative factors that make Snyder's-Lance a great pick, let's look at this really logically and quantitatively from a financial analysis side. Let's start with the current ratio. So the current ratio is great, one of the most commonly used methods for assessing organizational health and comparing companies of different sizes. This ratio reveals whether or not a company has the resources to pay off short-term obligations coming up within the next year. When we interpret this, everybody wants to be over 1. This is desirable because it means a firm can meet its financial obligations. Anything less than 1 is undesirable because that means a firm doesn't have enough liquidity to pay a year of short-term debt. So this looks bad, but don't worry. So Campbell's has currently a 79-cent share in current assets for every $1 in current liabilities. Obviously, this isn't optimal because it suggests that Campbell's doesn't have enough liquidity to pay its short-term debt this coming year. However, the issue's already been addressed in the 2017 annual report to shareholders as part of a holistic strategy to lower the core working capital requirements within the firm. The strategy has been underway for the last year. We saw great results last year, actually increasing our ratio value by quite a bit, and executives expect to see it continue to increase to where we expect to see it over that $1 mark. What this does mean as far as our limitations, it's getting better, but for right now, it means that we have a liquidity shortage and we cannot target firms that also have a liquidity shortage. If we target a firm with a current ratio less than 1, Campbell's may not have enough money to cover the target firm's short-term debts in the next year. So it just limits our choices of target firms for now. Luckily, Snyder's-Lance has an excellent current ratio. Snyder's-Lance has $1.61 in current assets for every $1 in current liabilities. We know Snyder's-Lance is an excellent candidate for acquisition in terms of current ratio because they have enough money to pay their short-term debt and then some. Campbell's actually could use the surplus money from Snyder's-Lance to pay off their own short-term debts if the two firms were to merge. We did perform analysis for if the firms merged, so their combined current ratio would be 88 cents to every $1 of liabilities. That is still under the $1 mark, but it's a significant improvement, and it will definitely help Campbell's reach our goals in the coming years of getting above that $1 mark. Now let's talk about price-earnings ratios. These are super useful for evaluating the attractiveness of a company's stock price compared to the firm's current earnings. It shows how much investors are going to spend for each dollar of profit the company makes. and it must be evaluated in terms of the industry average in order to draw conclusions about the firm's health. That said, higher PE ratios means the firm has great growth prospects, and lower PE ratios means the firm's prospects might be poor. So here we see that Campbell's Soup Company and Snyders Lance carry PE multiples of 16.2 and 25.43 respectively. The median PE ratio within the food and beverage industry is 24.3. So multiple conclusions can be drawn from this information. Number one, Campbell's PE ratio is lower than the industry median. This isn't a surprise because we know our growth prospects over the past few years have been decreasing. However, Snyders Lance has a really promising PE ratio. It's higher than the industry median of 24. This is a sign that the firm has great prospects for future growth, and that if we were to pursue acquisition, the odds of this firm adding value to our portfolio are high. Now we can talk about the combined PE ratio if we were to conduct an M&A with Snyders Lance. Combined, we would carry a PE multiple of 18.3, which while it's still under that industry median, it's significantly increased from 16.2. So again, showing that Snyders Lance adds value to our company. So now let's talk about total market valuation. Here we just took the outstanding shares and multiplied them by the price per share, which ultimately gave us a valuation for Campbell's of $14 billion and of Snyders Lance for significantly less at just $3.7 billion. Those numbers factor in to our two scenarios. The first is the scenario that we perform a cash acquisition and purchase Snyders Lance. Two assumptions are made here. First is that Snyders Lance and Campbell's have a synergistic benefit of $600 million. And second is that we acquisition Snyders Lance for $42 per share. The second strategy here is a merger by stock exchange. So bringing our companies together by exchanging stock at a ratio of 1 Campbell's share to 1.1 shares of Snyders Lance. And again, these calculations involve the estimated synergistic benefits of $600 million. So now let's look at what these calculations mean. As far as the cash acquisition versus the stock merger, one creates value and the other doesn't. A cash acquisition of Snyders Lance actually is $743 million cheaper than the stock merger. The stock merger actually would not make us money. It has an NPV and M&A of negative $520 million. So if we were to move forward with this, we would spend $743 million to do so. Now the combined price per share of the cash acquisition is $2.47 more than the combined price per share of the stock merger. In other words, buying Snyders Lance outright adds $2.47 per share more so over what the merger could potentially add. So the conclusion to draw is that the cash acquisition here is clearly, not only is it more profitable, it's actually really the only option if we want this M&A to be successful. So finally, the long-awaited recommendation. With all of our qualitative and quantitative analysis, the research department of Campbell's Soup Company suggests that the board acquire Snyders Lance Inc. with cash by purchasing the firm for $42 per share. Just as an overview, this is a great opportunity because it diversifies Campbell's portfolio with rapidly growing healthy snack brands. It provides economies of scale to help us compete at that bottom line of price. It increases liquidity to pay for our short-term debts, and it increases combined price per share to maximize shareholder wealth, which, as we all know, is the bottom line. So with all of that said, I know it was quite a lot of research to be presented and digested at once. I want to thank all of you for your time and for your open mind. I'm really excited about this moving forward, and I'll open the floor to any questions or comments.